Let's examine the inventory processes and how they differ in QuickBooks versus our manual ledger books. There are 5 general categories of adjusting entries. We'll work with 3 of these categories in our system understanding aid: accruals, estimates, and revaluations. This specific lecture works with revaluations, the adjusting entry that's necessary when reality isn't reflected in our financial statements. We need to record entries to make the valuation here of our inventory reflect what's present in our physical counts. To illustrate this concept, let's imagine we're building the Corvette that I will one day buy when I'm awarded tenure. Corvettes are comprised of labor, direct materials, and overhead. So let's focus on just the materials piece. In recording the different components that go into building a Corvette, we would record the purchase of these raw materials in the inventory account, noting the increase in inventory with a debit, and recording an offsetting credit to either cash or accounts payable. When we sell the inventory, here, a completed Corvette, we debit cost of goods sold to write down our inventory, and we debit accounts receivable or cash to reflect the asset that's coming into our possession. Typically, on the quarterly basis, we count inventory to make sure that what's recorded on our books is the same as what exists in reality. If adjustments are necessary, they're recorded to the cost of goods sold account at that time. So this flow of information looks like the pictures below. We start the month with a certain quantity of inventory. We add to it any inventory purchases. We deduct from it the cost of goods sold, and we're left on our books with a certain quantity of ending inventory. Our QuickBooks simulation uses a perpetual inventory system. That is, each time we purchase inventory, we record a debit to inventory based on the item and the cost paid for that item. As we sell each item of inventory, we write it down using the cost of goods sold. At any given point in time, our inventory count and dollar value should be reflective of reality. So let's take a look at that more specifically. We can view our inventory counts by clicking on the inventory activities under the company grouping using the drop-down selection Inventory Center. For example, item BB538, basketball bags. This is an item we purchased from Velocity Sporting Goods. We pay them $26 for the item and sell it for $39. At the present, we have 8 on hand, and we've ordered 125 of these items on the purchase order we created earlier in the month. Now, we've received this inventory from Velocity with an invoice attached. We select the Receive Inventory with Bill and select the Velocity Sporting Goods vendor information in the drop-down bar. We can tell it yes because we do want to receive inventory against one of the existing purchase orders. And then we update the records based on the number of items received. The inventory was shipped to our location on December 19th, 2022. And we received all of the goods in good condition except for item BB019. We only received 85 of these items. When we update the quantity, we can see that the amount due is 22,515, a number that should look familiar from our manual accounting simulation. Once we're sure that everything is correct, we can save and close. Now, when we go back to the inventory center, we can search for item BB538. Now we can see that we have 133 of these items on hand. And if we were to refer to our inventory in our trial balance, we would see that it increased by the volume of inventory added through this receipt. At the end of each period, typically a quarter or year in a perpetual system, we need to perform a physical count to make sure that the quantity that we have in our warehouse and en route to our customers is the same as what's recorded in our system. We do that via the Inventory Activities icon under the Company tab, selecting the option Adjust Quantity/Value on Hand. On page 9-18 of our computerized accounting textbook, we're given a list of 3 items where the counts were different than what was reflected in our financial statements. So we can go ahead and adjust these now. The first item requiring adjustment was BB019, the basketball pole set. For our records, we have 96 regular basketball pole pads and 10 returns. Here we see 96 basketball pole pads regular, but we actually have 99. So we increase this, and when we're complete, we would select Save and Close. Let's go ahead and update the other 2 items. We have FB027 and BA158. We show in our perpetual inventory records 159 shoulder pad sets. In reality, we only have 147, so we need to adjust our cost of goods sold accordingly. We show on our records 156 packages of baseballs. In reality, we have 162, so we need to decrease our cost of goods sold accordingly. We double check that the counts are correct per our written records, and then we hit Save and Close. Now we can go back to the inventory activities and review BA158, the baseball game balls, and see that our record now shows 162 packages on hand ready for sale. Now let's look at the periodic inventory system, which is used in the written accounting simulation. In a periodic inventory system, we record all purchases of inventory to a debit account for purchases and credit cash or accounts payable. When we sell inventory, we record a debit to account receivable or cash to reflect the asset coming into our organization, and we credit sales. We do not make an adjusting entry to purchases until a specified point in time. When we count inventory at the end of the month, the quarter, or the year, we adjust everything to the cost of goods sold based on the physical count of inventory on hand. To compute the cost of goods sold, we add the total volume of purchases to the beginning inventory at hand and subtract the ending inventory that we obtain from performing a physical count. What's left after that is our cost of goods sold. However, other items come into play in calculating the valuation of inventory. We're given that our beginning inventory in the simulation was $101,681. We add to it $1.137 million in purchases, and based on our physical count at the end of the period, we have $202,920 of inventory left on hand. We adjust that ending inventory amount for the value of freight in and subtract any returns we made on our purchases, as well as any discounts we received from early payments. After this adjustment, we compute our cost of goods sold to be $1,024,609.94. At the end of the period, our journal entry to adjust our inventory valuation as well as our cost of goods sold is as follows. We debit cost of goods sold in the amount we computed on the previous slide. We also debit purchase returns and allowances and purchases discounts taken. We'll leave inventory blank for just a sec. This is a plug based on the remaining activity that took place during the preceding period. We will credit purchases, undoing that account and closing it to cost of goods sold and inventory, and we will credit freight in. When we total our debits and credits, we get $1,060,789 in the debit column and $1,162,028 in the credit column, leaving a difference of $101,239. This indicates that our inventory increased in the sum of $101,239 during the preceding period. That's the last of the adjusting entries. Once you've prepared the adjusting entries, you're near the end of the accounting cycle. Prior to preparing the adjusting entries, you would have prepared the month-end trial balance after recording all of your regular periodic activity. Once you've recorded the adjusting entries, you transfer the transactions from the general journal where you recorded them to the general ledger and then update the general ledger balances. Once you've done that, you can record the adjusted trial balance and then use the adjusted trial balance to prepare the statements in the order discussed, beginning with the income statement, followed by the statement of retained earnings, followed by the balance sheet, followed by the statement of cash flows.